Have you ever wondered what really happens to your money after you deposit it in the bank? No, it's not sitting in a vault waiting for you. In fact, banks use a system called fractional reserve banking to multiply your money, but not in your favor. While you think your balance is safe, that money is being lent out, invested, and put at risk. And the worst part? If something goes wrong, you are the one left with the losses. In this video, you will discover how this system works, the hidden risks no one talks about, and most importantly, how to protect yourself by diversifying your assets. If you want to make sure your wealth does not become fuel for bank profits, watch until the end. Imagine a magician on stage. He shows a single $100 bill and, with a quick move, turns it into $1,000. Amazing, right? But unlike magic, this trick happens every day within the banking system. The concept of fractional reserve banking has existed for centuries and was originally designed to stimulate economic growth. However, over time, this practice became a tool to artificially expand the money supply in the economy. Banks don't need to keep all the deposited money. They only hold a fraction, often around 10%, and lend out the rest. So that $1,000 you deposited simultaneously exists in multiple accounts. The system grows, but the real monetary base remains unchanged. Now, let's break down how this system works. Suppose you deposit $1,000 into your account. The bank keeps $100 and lends out $900 to another person. That person uses the money to pay a supplier, who then deposits the same $900 into another account. The bank keeps $90 from that deposit and lends out the remaining $810. This cycle repeats multiple times, creating multiple balances from the same initial deposit. It seems like economic magic, but it's a fragile construction sustained by depositor trust. But what happens when that trust disappears? The banking system operates like a house of cards. If a significant number of people decide to withdraw their money at the same time, the bank won't have enough funds to cover all requests. This event is called a bank run, and it was exactly what happened during the 2008 financial crisis. Banks that had lent too much and kept too little went bankrupt, causing millions of people to lose their savings. The scariest part? This risk still exists. The system continues to rely on the public's blind trust. To understand the stakes better, let's take a historical journey. During the Great Depression in 1929, the collapse of American banks revealed just how fragile the system becomes when there is widespread distrust. Back then, millions of Americans lost their savings because banks didn't have sufficient reserves. This catastrophic event led to the creation of protective mechanisms like the FDIC in the United States. But even with such safeguards, the risk persists, especially in times of global economic uncertainty. Furthermore, financial globalization has introduced new challenges. Today, banks are interconnected in a complex network, which means that problems in one country can quickly spread to others. We saw this during the European debt crisis in 2011 when Greece's banking problems impacted institutions in France, Germany, and beyond. This interdependence makes the system even more susceptible to external shocks, emphasizing the importance of understanding and mitigating the risks associated with fractional reserve banking. Let's dive deeper into how this system impacts your everyday life. When you use your credit card, take out a mortgage, or apply for a personal loan, you're actively participating in this fractional system. Credit is extended based on deposits that technically exist multiple times across different accounts. This creates a cycle of debt and credit that fuels the modern economy. However, when lending becomes excessive, it inflates asset prices beyond their intrinsic value, leading to speculative bubbles that can eventually burst. One notable example of this phenomenon is the housing market crash of 2008. Banks issued loans to borrowers who were not creditworthy, under the assumption that property values would continue rising indefinitely. As demand grew, housing prices skyrocketed. But when defaults increased, the market collapsed, dragging major financial institutions along with it. This demonstrates how an imbalanced fractional reserve system can create systemic risks that ripple through the entire economy. Another critical aspect is the role of central banks. In the United States, the Federal Reserve regulates reserve requirements and sets interest rates to control the money supply. When the Fed lowers interest rates, borrowing becomes cheaper, encouraging banks to lend more. While this stimulates growth, it also increases systemic risk by expanding the money supply beyond sustainable levels. Understanding these mechanisms helps you anticipate economic cycles and make informed financial decisions. Let's also examine how this impacts global markets. For instance, during the COVID-19 pandemic, central banks around the world, including the Federal Reserve, implemented aggressive quantitative easing programs. This involved injecting trillions of dollars into the financial system to prevent an economic collapse. While this strategy provided temporary relief, it significantly increased the money supply, raising concerns about inflation and long-term economic stability. The ripple effects of these policies are still being felt today. In addition, digital banking innovations have introduced new dynamics to the fractional reserve system. With the rise of fintech companies and digital wallets, money is circulating faster than ever before. Mobile apps allow users to transfer funds in seconds, creating a more dynamic and less predictable flow of money. However, many of these institutions operate outside traditional regulatory frameworks, which can amplify risks in times of financial stress. So, what can you do to protect your hard-earned money? The first strategy is asset diversification. Avoid keeping all your money in your checking account. Consider allocating funds to U.S. Treasury bonds, real estate investment trusts, and international investment opportunities. This diversification reduces your exposure to systemic risk. A popular approach is the 30-30-30-10 rule. 30% in fixed income, 30% in real estate, 30% in equities, and 10% in alternative assets like gold and cryptocurrencies. While diversification doesn't guarantee profits, it significantly protects against catastrophic losses. The second step is understanding FDIC insurance. The FDIC insures deposits up to $250,000 per account holder per institution. If you have more than that in a single bank, consider spreading your funds across multiple banks to maximize your coverage. This simple action can make the difference between safeguarding your wealth and facing a substantial loss in the event of a bank failure. Additionally, consider alternative financial services like credit unions and digital banks. Credit unions often operate on a cooperative model, prioritizing members' interests over profits. Digital banks may offer innovative solutions and higher interest rates on savings due to their lower operational costs. Evaluating these options can provide you with more flexibility and security. Another useful strategy is keeping an eye on macroeconomic indicators. Monitoring metrics like inflation rates, interest rate trends, and employment figures can provide early signals of potential financial instability. For instance, a sudden spike in inflation might indicate that the money supply has expanded too rapidly, increasing the likelihood of tighter monetary policies and potential market corrections. Lastly, invest in financial literacy. Knowing how the banking system works is your best defense against hidden risks. Read books on economics, stay informed through reliable financial news sources, and consult with professionals when necessary. Knowledge is the ultimate weapon against banking system pitfalls. Now that you've uncovered the secrets behind fractional reserve banking, the choice is yours. Will you continue to trust the banking system blindly, or will you take charge of your financial future? If you're looking for more tips on how to protect your wealth and make smart investments, subscribe to the channel, turn on notifications, and share this video with others who need to know this reality. Together, we can transform knowledge into financial security. And thank you for watching. More videos coming soon, and see you next time, my friends.